Are you self-employed? Do you do any consulting, freelancing, or run any kind of side business, even part-time? Because if you do, there is a retirement account available to you right now that most financial advisors never mention to their self-employed clients. It allows you to contribute, get this, up to $77,500 per year. It can invest directly into commercial real estate, and it comes with a loan provision that lets you borrow up to $50,000 from your own account, penalty-free, and deploy it as investment capital. Here's my question. If you could put $50,000 to $100,000 of tax-sheltered capital to work in a physical income-producing asset, like real estate, without penalty, without liquidating anything, would you want to know how? Because that's what I'm going to be covering today. My name's jroma. I'm the owner of CRE Real Estate Investments. And this is video 2 of a 3-part series on creative capital vehicles for commercial real estate investing. Today we're gonna go deep into solo 401ks. So no hype, no fluff, structure, math. So let's go. Before we get into the mechanics, let's answer the most important question first. Do you qualify? Here's the IRS criteria, and pay close attention because this surprises a lot of people. You qualify for a solo 401k if you have self-employment income from any business where you have no full-time W-2 employees other than a spouse, okay? So that's it. You don't have to be full-time as a self-employed person. You don't have to have a formal business structure. You don't even have to give up your day job. If you have a W-2 job and you earn any 1099 income on the side, so consulting, even coaching, real estate commissions, a side LLC you've set up, a part-time business, you likely qualify. Sole proprietors qualify, single member LLCs qualify, even S corporation owners qualify. Real estate professionals, healthcare consultants, coaches, contractors, and agency owners, they all qualify. The question isn't whether you qualify. The question is whether you've taken advantage of it yet. So here's what I see constantly. Self-employed professionals and business owners, people with real income, real discipline, real financial intelligence, contributing to a standard IRA. That's $7,000 a year. That's it. That's the limit. Meanwhile, the solo 401k is sitting right there, available to them with contribution limits nearly 10 times higher. The reason most people don't know about this vehicle is the same reason most people don't know about the self-directed IRA we covered in video 1. The financial industry makes its money managing assets in standard products, right? So solo 401ks that invest in alternative assets like real estate, private equity, syndications, they don't generate commissions for the people who'd normally be advising you. So they don't bring it up. I'm bringing it up because if you're serious about building wealth outside of the stock market, this is one of the most powerful tools available to you, and it's completely IRS approved. So let's build the foundation. A solo 401k, also called an individual 401k or self-employed 401k, is a retirement plan designed specifically for self-employed individuals and small business owners with no full-time employees other than your spouse. It combines 2 contribution types that most retirement accounts separate, right? You contribute as an employee up to the elected deferral limit, and you contribute as an employer, an additional profit sharing contribution of up to 25% of your net self-employment income. That combination is what really creates the staggeringly high annual limits. And when you set it up as a self-directed 401k with a custodial or planned administrator who allows alternative investments, the account can invest in real estate, syndications, tax liens, private notes, and much more. So just like the self-directed IRA, the solo 401k is the investor. The account owns the position. All income flows back into the plan and is tax sheltered. So let's talk about numbers, because this is where the 401k, the solo 401k separates itself from any other vehicle. For 2026, the contribution limits are as follows. If you're under 50, you can contribute up to $70,000 total. If you're 50 or older, up to $77,500. And if you're between ages 60 and 63, up to $81,250, thanks to the special catch-up provision under the Secure 2.0 Act. So to put this in perspective, a standard IRA caps you at $7,000 a year. A solo 401k caps you at between $70,000 to $81,250 every year. That's 10 times the contribution potential. Now, can you always max it out? No. Your employer contribution is capped at 25% of your self-employed income. But even at that modest side income level, the solo 401k outperforms every other self-employed retirement option by a significant margin. And every dollar you contribute is a dollar that can be invested in real estate assets, not just index funds. Here's a feature of the solo 401k that most people don't even know about. And once they learn about it, it changes how they think about the whole entire vehicle. It's called checkbook control, okay? When you set up a self-directed solo 401k with checkbook control, the plan holds the dedicated checking account, and you, the plan trustee, have direct signing authority over that account. That means when you identify an investment opportunity, a real estate syndication, a private note, a tax lien, you don't have to submit a request to a custodian, wait for approval, and wait for a wire. You just write the check. Or you initiate a wire directly from the plan's bank account. In the world of real estate investing, where timing matters, this is a meaningful advantage for sure. It also eliminates many of the pre-transaction custodial fees that standard self-directed IRAs carry. Checkbook control is not available with a standard IRA. It is one of the key structural advantages to the solo 401k, and it holds over the SDIRA for active investors. So now here's the feature that surprises people the most. The solo 401k has built-in loan provisions. So the IRS allows you to borrow up to 50% of your account balance, or $50,000, whichever is less, directly from your solo 401k. No credit check, no bank approval, no tax penalty, no early withdrawal consequence. You borrow from yourself. Pay yourself back with interest over up to 5 years, and the interest goes back into your own account. Think about what this means for a new investor who hasn't accumulated a large balance yet. So if you have, say, $60,000 in your solo 401k, you can borrow, again, 50%, $30,000. Deploy it as an LP investment in, say, a CAE real estate deal, and repay yourself over 5 years while the deal generates preferred return distributions. The deal has partially funded its own repayment. This is sophisticated capital strategy, and it's completely IRS compliant when structured correctly. Just like the self-directed IRA, the solo 401k comes with two tax structures. So you have traditional solo 401k. Contributions are pre-tax, growth is tax deferred, and you pay taxes on distributions in retirement. Roth solo 401k, contributions are after tax, and all growth, every distribution, every equity gain is completely tax-free. So here's what makes the Roth solo 401k particularly compelling to real estate investors. You're not just sheltering $7,000 a year like a Roth IRA. You're potentially sheltering $70,000 or more per year, growing tax-free in an account that can own real estate positions, earn preferred returns, and participate in equity at exit. I mean, the compounding effect of that over 10 to 20 years is staggering. One more advantage to the solo 401k, that it holds over the self-directed IRA, there's no UBIT. So the unrelated business income tax on leveraged real estate inside of a solo 401k, this is a meaningful distinction. If the deals you're investing in use any debt financing, so that's important, which most big commercial real estate deals are going to use debt financing. So consult with your CPA, but this is a structural advantage that matters. And how it applies to a CAE deal. Let me connect all of this directly to what investing in a CAE deal looks like. So CAE real estate investments, we structure syndications as limited partnership investments. So you, or more specifically your solo 401k, invests as a limited partner, a passive LP. The plan receives an 8% preferred return on the investment capital. Those distributions flow directly back into your solo 401k, tax deferred or tax free, depending on your structure. And when the asset sells or refinances, the LP investors receive their pro rata equity distribution, also flowing back into the plan. You did none of the work. The plan owns the position, and every dollar of return is compounded inside a tax sheltered structure. For a self-employed investor who qualifies for a solo 401k, this is one of the cleanest ways to deploy capital, deploy your retirement capital into an institutional quality commercial real estate deal that exists in the market today. All right, 3 things before we close this video. Number 1, subscribe and hit that like button. Video 3, the HELOC strategy, drops sometime soon. And if you're a homeowner, that one is going to change how you think about the equity sitting in your home. Number 2, comment the word solo below or grab the link in the description and I'll send you the full CRE Capital Playbook. It covers all 3 capital vehicles. So self-directed IRAs, solo 401ks, and HELOC, with contribution limits, tax treatments, restrictions, side-by-side comparisons, and decision framework. It's free, it's institutional level, and it's yours. And number 3, if you are self-employed, have a side business, or earn any 1099 income and are interested in deploying capital into a CAE self-storage deal, book a 30-minute call. There's a link in the description. It's in my bio. No pitch, no pressure. We'll set up a time to talk. We'll look at your situation and tell you honestly whether we think you're a fit or not. So I'm Jeff Roma. This is CAE Real Estate Investments. No hype, no fluff, just structure and math.